So as on acquisition method, we have the steps, Nana. So same thing we are following here. First one is identification of acquirer. So Ind AS 103 provides accounting for business combination, in the consolidated financial statement of acquirer company on the date of acquisition. On the date of acquisition, because business combination is occur, as I told you, that when one company acquires the control over the business of another company. One company acquires the control over the business of another company. So on the date of acquisition, means in which date they are getting the control, or in which date they are paying the purchase consideration, whatever it might be. So on which date they are getting the control, on that date we have to prepare consolidated financial statements based on Ind AS 103 business combination. The following steps are involved. Step 1, identifying the acquirer. Identifying the acquirer. For each business combination, one of the combining entities shall be identified as acquirer. So generally the company who acquires the control, we can say he is acquirer. Okay, but some exceptional cases also there, no? So what are the cases? Reverse acquisition. In case of reverse acquisition, accounting acquiry will be the, legal acquiry will be the accounting acquirer. So any one company of that combining entities, we can say that one of the combining entities shall be identified as acquirer. So the guidance of Ind AS 110, Ind AS 110 deals with consolidated financial statement. The guidance of Ind AS 110 shall be used for identifying the acquirer, the entity that obtains a control over another entity. So the another entity we call it as acquiry. So which entity is obtaining the control over the another entity? So that entity we can call it as acquirer. Acquirer. We are identifying the acquirer in that scenario. Coming to determination of here, determining the acquisition date. Date of acquisition, how can you determine? The date on which acquirer obtains the control of the acquiry is generally the date on which acquirer legally transfers the consideration, acquires the assets and liabilities of the acquiring company. In which date we are acquiring the assets and liabilities, and in which date we are paying the purchase consideration legally. So that particular date we can call it as date of acquisition. That will be the closing date. However, the acquirer might obtain a control on the date either earlier or later than the closing date, depends upon the scenario. But if approval is required from the government, so then the date of approval by the government will be considered as acquisition date. And third one, determining the purchase consideration. So generally the amount of purchase consideration is given in the question. However, for concept based questions, anything like multiple choice question, if they are asked, so to find out the purchase consideration, we will follow these steps. Purchase consideration is the amount paid to the owners of acquiry company. Who is paying the amount? Acquirer company is paying to whom, Nana? To the owners of acquiry company. For what? For obtaining the control. So PC can be calculated. First of all, the acquisition date. On acquisition date we are taking that, and which values we are taking? Fair values. So how much cash you paid? The fair value of cash we don't have. The same value will be there here and there. So cash paid plus fair value of assets transferred. And if you issue equity shares, the fair value of the equity shares issued, or if you issue debentures, fair value of debentures issued. If any deferred consideration is there, we have to calculate the present value of deferred consideration, and fair value of contingent consideration. So these all the things we are adding in order to find out the purchase consideration. Okay, so in all the cases in the problems of business combination, they will give you purchase consideration. So if not, we can follow these rules to find out the purchase consideration. That is step 3. Coming to step 4, all the things are coming here. Identification, recognition, measurements of net assets taken over of the acquiring company by the acquirer company. So we are identifying the net assets. At the same time, we are recognizing the net assets, and we have to measure it, which values, fair values of the net assets that we have find out. all the assets and liabilities of acquiring company are taken over at fair values. On which date? On the date of acquisition. Okay. Some exceptional cases we are having, like contingent liability of acquiring company is also taken over and recognized as a liability. Contingent liability for acquiry, but we will recognize it like a liability at fair value on the date of acquisition. Generally, it is an exception for recognition principle. Acquiring company is not recognized that as a liability, but we are recognizing it as a liability. So that is an exceptional rule for recognition criteria. Coming to such intangible assets that meet the recognition criteria as per Ind AS 38. Ind AS 38 deals with intangible assets. So, as per Ind AS 38, it meets the recognition criteria, but are not recorded in the acquiry books, are also taken over at recognized at fair value on the date of acquisition. So just like example, internally generated goodwill or internally generated customer relationship or internally developed patents, etc. So internally generated intangible assets, generally we should not record in the books of accounts. So that's why they followed that, and they have not recorded such assets in the acquiry books, but still for acquisition purpose we have to identify that kind of assets also, and will be recognized at fair value on that particular date of acquisition. And this is the point, Nana. Generally, liabilities for income tax dues. If any income tax due is there for acquiring company, or any employee benefits are there for acquiring company, that also we are taking. Income tax due is a liability for acquiring company. So employee benefits that you are given by acquiring company to their own employees, that is also a liability, Nana. As such also will be taken over and recognized and measured, but here we are not following Ind AS 103 principle. For income tax dues we are following Ind AS 12, and for employee benefits we are using Ind AS 19. That means we are following the rules of other Ind AS. Okay, so as per Ind AS 12, how to do accounting for income tax due, the same way we are following here for the recognition. And as per Ind AS 19, how we are following for economic benefits, same accounting we are applying in the business combination for the acquisition purpose. We are following some other accounting standards. So that is an exceptional principle, Nana. It is an exception for both recognition and measurement principle as per Ind AS 103. Such cases. And indemnification asset. Indemnification asset which is not recorded by acquiring. Only for acquisition purpose, a new asset is emerged. A new asset is arrived right now. Indemnification asset promised by acquiring company shall also be taken over, and it is also an exception for both recognition and measurement principles. And non-current assets held for sale of acquiring company having one non-current asset which is held for sale, not for held for use it in the business. Held for use means property, plant and equipment. Held for sale means we have separate standard called Ind AS 105. Non-current assets held for sale and discontinued operations. If such assets are there, that also taken over at fair value less cost of disposal. That is as per which rule, Nana? Ind AS 105. So there for recognition purpose we are using the rules from Ind AS 105, which is also an exception to the measurement principle of our standard. Ind AS 103. Next one, reacquired rights shall also be taken over and recognized at fair value. So these all are the things we have make. And none up to here clear? So the same points what we discussed earlier. Next one, step 5, calculation of non-controlling interest. Non-controlling interest. What is non-controlling interest? A minority interest is non-controlling interest. Non-controlling interest means for that particular stakes, acquirer does not have any control. Okay, if acquirer holds 80% of stakes in acquiring company, the balance 20% acquirer is not having control over it. Such type of stakes that we call it as non-controlling interest. The remaining 20% is non-controlling interest. If acquirer having 70% stakes, 30% is non-controlling interest. 60% stakes, 40% is non-controlling interest. 40% stakes, 60% is the non-controlling interest. How much he is having the control over the business, the remaining thing will be comes under non-controlling interest. So how do you calculate this non-controlling interest? It is a portion of acquiring company not owned by acquirer, Nana. This is acquirer, not owned by acquirer company. It is a portion of acquiring company, not owned by acquirer company. So acquirer is not owned. That means somebody else will be owned that particular shares. So how can you compute the non-controlling interest on the acquisition date? On the date of acquisition, we have to calculate non-controlling interest also. So non-controlling interest can be computed at the based on fair value or on the basis of proportionate share in the net asset basis. Okay, fair value basis, again I will give you the notes for that. Okay, so don't worry. So here they have given share wise they have given, but we will do proportionately, consideration wise we will follow that. Okay, same thing we will get. So share wise, how do you calculate the non-controlling interest? That we will discuss in consolidated financial statements. In consolidated financial statements also, you have to find out the amount of NCI, non-controlling interest. There we will take share wise. Okay, based on the share wise we will take that, but for business combination based on consideration we can consider that. Okay, don't worry. So non-controlling interest at a fair value. Fair value means fair value per share of acquiring company into number of shares held by NCI. So which is nothing but what is the fair value of share of acquiring company. Here we are not taking the share wise fair values. Okay. So generally this will apply when we are doing consolidated financial statements. There you can understand better. Okay. At present level, how can you calculate on fair value basis? Means consideration paid by acquirer company. Consideration paid by acquirer company. So in the morning problem I told you 7 lakhs I paid or 8 lakhs I paid purchase consideration. 8 lakhs I am paying for 80% of stakes. For 20% how much? 8 lakhs we are paying for 80% stakes, 20% how much? That will comes under fair value basis. Proportionate share in the net assets basis, Nana? Proportionate share in the net assets basis. So net assets, how much we will take first? Net assets, I told you 700 lakhs or something we got net assets. So out of 700, 20% belongs to NCI. So directly we are taking on the proportionate base on net asset basis. That is next one. NCI on proportionate share in net asset basis. So here we are taking net assets at the fair value of acquiry as at the date of acquisition. On the date of acquisition, what is the fair value of net assets? Here 100% value we can take. 100% net assets value we have to take. In that, what is the percentage stake of NCI? If 20% means into 20%, 30% means into 30%, PSNA basis. Okay. NCI is shown as a separate line item in the equity under the head of balance sheet in the consolidated financial statement of acquirer company. This NCI we have to show as a separate line item of equity. So that means in the equity, so equity part, we are having share capital and we are having other equity, Nana. So separate line item we have to give for NCI also. Okay. So under the equity only we will show NCI also in the balance sheet as a separate line item. Okay, underline that point, separate line item in the equity head of the balance sheet in the consolidated financial statements. And NCI shall not come into play when acquirer obtains a control over the acquiring net assets of acquiring company. So entire net assets is purchased by acquiring company. So 100% net assets we purchase. So there is no question of non-controlling interest. Or acquirer obtains 100% stakes of acquiring company. Then also there is no question of non-controlling interest. Okay, Nana? Any doubt in that? Fair value basis and doubt? Back. Fair value basis we have taken into consideration based on purchase consideration wise. Purchase consideration wise, we can calculate the NCI under fair value basis. But while we are doing consolidated financial statements, there we can take a, so like the fair value of share, how much, what is the, how many shares are held by NCI, how much. Okay, so based on that, we were taken into consideration. For example, here in acquiring company 10,000 shares are there, Nana. Acquiring company having 10,000 equity shares. Acquiring company having 10,000 equity shares. Out of 10,000 equity shares, 8,000 equity shares are held by acquirer company. So remaining how many shares held by NCI? 22,000. So 2,000 shares are held by NCI. 2,000 into fair value of that share. Automatically we will get NCI. Okay, the same thing like consideration, because business combination when we are doing purchase consideration base, we can take for the fair value basis. Same answer we will get. Okay, when we are doing consolidation, I will show you both the methods. So that is one thing. NCI, have you have any doubt relating to NCI? So how many bases we are having for calculation of NCI, Nana? Two bases. One is fair value basis and proportionate share in net assets basis. Again, I will give you notes for that NCI calculations. Okay. Fair value basis, if you prepared NCI, fair value basis, if you prepared NCI, so whatever the goodwill we are getting, that goodwill is full goodwill. As I told you, full goodwill. That goodwill includes acquirer share as well as acquiree share. Under proportionate share in the net asset basis, if you compute the NCI, then whatever the goodwill arising, that is a partial goodwill, that is the only goodwill which is related to acquirer. Only acquirer share of goodwill only we will get it. Okay. So that is the thing. And coming to next, recognizing and measuring the goodwill and gain on bargain purchase. Goodwill and gain on bargain purchase. Here, I told you one method in the morning. So 100% fair value of net identifiable assets. Okay, some amount we are having. Less what we deduct, Nana? Non-controlling interest we are deducting. So then what we will get? Parent share we will get. Parent share in the net assets or net identifiable assets we will get. And from parent share, what I am deducting? Purchase consideration. If purchase consideration is more than the parent share, then goodwill will come. If purchase consideration less than the parent share, gain on bargain purchase will come. That is one method. That is one method. Or otherwise, you can do one thing. If you add purchase consideration, because we are deducting in simple shortcut, we can say that net identifiable assets. Net identifiable assets means here we are talking about 100% value and also fair value of net assets, that we call it as net identifiable assets, minus NCI minus purchase consideration. We will get goodwill or gain on bargain purchase, isn't it? Okay, so we'll get either goodwill or gain on bargain purchase. This is a method we followed regularly, but they have given another one also. Simply, if you add NCI first, NCI and purchase consideration, NCI and purchase consideration. For example, 1000 net identifiable assets, in that 200 NCI minus 700 purchase consideration. Sorry, 700 purchase consideration. So how much will be the no? So which one is more? How much? It is a gain on bargain purchase. Gain on bargain purchase. Simply 1000 minus 200, 800. 800 worth of net assets. 700 we are paying. Okay. So that is gain on bargain purchase. So this we can find like that. First you add 200 plus 700 total. 900 minus 1000. So then also we will get the same. So that means we are aggregating non-controlling interest and purchase consideration. When you are aggregating purchase consideration and non-control interest, and we will check with net identifiable assets. First, we are aggregating means we are adding non-controlling asset and purchase consideration, and we are comparing with net identifiable assets. So likewise also we can compute goodwill or gain on bargain purchase. Two methods they have given here. Step 6, recognition of goodwill or gain on bargain purchase shall be excess of A over B. How much excess of A over B? In the A, they include that aggregation of consideration transferred and measured in accordance with Ind AS and generally requires acquisition at the date, acquisition date, fair value. So how much consideration you transferred, which is nothing but purchase consideration. And we are aggregating purchase consideration with what, Nana? The amount of non-controlling interest in the equity measured in accordance with Ind AS. So NCI. We are adding purchase consideration plus NCI. So then we are comparing these two. Then a third one, why I am not discussing means here that is a different case. business combination achieved in stages. Okay, that I will tell you once after completion of this. Okay, for time being, third point you leave it. For time being, just for 5 minutes. Okay, first first 2 points only you can take. First one, Nana, consideration transferred according to Ind AS, which is nothing but purchase consideration. What is the second point? Non-controlling interest. First you add both. Okay, first you add both. Now how much amount we got if you add both? 900. So A is 900. A is 900. Okay. Now what about B? B is nothing but net of acquisition date amount of net identifiable assets acquired and liability assumed measured in accordance with Ind AS. Simply we can say net identifiable assets. The fair value of net identifiable assets. This is B. If excess of A over B, that means if A is more than B, if A is more than B, then I can say net identifiable assets is 800. Okay, now A is more than B, Nana. A 900 we got when we are adding purchase consideration plus NCI. A is nothing but PC plus NCI 900, and net identifiable asset is how much? B is 800. Okay, now if purchase consideration plus NCI is more, A is more than B, then you are getting goodwill. Then you are getting goodwill. Okay, if B is more than A, then gain on bargain. That is what they intended to tell us. Okay, so here A means aggregation of purchase consideration and non-controlling interest. Aggregation of purchase consideration and non-controlling interest, and B is nothing but net identifiable assets. This is one method. Or alternatively, we having one thing, 100% net how much minus NCI. Next we got share of acquirer, parent share we will get. From the parent share we are removing consideration. If consideration is more than parent share, we will get goodwill. Less than parent share, we will get gain on bargain purchase. Gain on bargain purchase. This is the entry, Nana. So first of all, that is the thing. So goodwill, when we will get excess of A over B, we will get goodwill. Excess of B over A, we will get gain on bargain purchase. These excess questions we don't want. Just you leave that format and you can follow this format. Alternative format we are having no. So every time we are talking about the same thing, 100% net identifiable assets, how much? Which is nothing but net assets of acquiring company. Net assets of acquiring company, fair value on the date of acquisition. Fair value on the date of acquisition. What is the net assets? What is the net assets? First you calculate. From that we have to remove NCI. NCI can be calculated in two bases, either fair value or proportionate, according to the question. In the question, both the cases also they will ask you. Both the cases also they will ask you. So prepare NCI based on net assets, based on fair value basis or based on proportionate share in the net asset basis. Anything. So then you will get a parent share and compare that parent share with consideration. With consideration. If consideration is more than parent share, goodwill, less than parent share, gain on bargain purchase. Okay. Now you come back to the third point here. In the A, we have third point. If in a business combination achieved in stages on the acquisition date, fair value of acquirer previously held equity interest also, we have to take it in the acquiring company. So for example, business combination. A acquired 40% of shares in B Limited. A acquired 40% of shares in B Limited. Does business combination will occur here? No, because control is not there. So when he got the control, means this has happened on 1/4/2023. 1/4/2023, A acquired 40% of stakes in B Limited. Okay. Now, after 1 month, 1/5/2023, A again acquired additional stakes from B Limited, 20%. So initially he acquired 40%. Now he acquired, Nana, 20%. So total 60% he hold. Then he can pass with business combination. 103 will apply. Yes, that means here business combination is occurred in stages. Okay, business combination we achieved in stages. Okay, in stages when we are making, we have to consider the previous equity interest also. Initially he is having equity interest 40%, now 20%. So immediately we got a control. So when you got the control, 1/4/2023 we don't have control, but 1/5/2023 we have the control. That means business combination we achieved in stages, stepwise. So in such conditions are there, we have to consider this interest also. So that is what the meaning over here. If such things, any previously held equity interest is there, that also we have to aggregate. In business combination achieved in stages of acquisition, the fair value of acquirers previously held equity interest in the acquiree. So the fair value of the amount initially, previously what he is having, that also we can aggregate. That will be happen only when business combination achieved in stages. For all the cases it will not be occurred. That's why I told you purchase consideration plus NCI, purchase consideration plus NCI, plus if any business combination achieved in stages, previous equity interest also we are taken into consideration. So that means here purchase consideration, how much done in the example I told you? Purchase consideration, how much we paid? 700 we paid. Now same 700, you can think like that. So 40% of stakes I paid 400 consideration. Purchase consideration, how much I paid? 500 for 40% stakes. Okay. Next, for 20% stakes I paid 200 purchase consideration. Okay. Now actually when you are doing business combination, we have to consider purchase consideration. But if you have any previously held in the equity interest, that also we have to add. That means for 200 we have to add 500 total purchase consideration we will take. Total purchase consideration we will take. So that means here three things we are having aggregation. First one, consideration transferred in accordance with Ind AS generally on the acquisition date at fair value. On the acquisition date, how much you transferred? 200 you transferred. Okay. And what is the amount of non-controlling interest? 200. 200 is a non-controlling interest. And previously consideration, how much done fair value? 500. That is what the meaning here. Okay. So that means on the date of acquisition 200 plus NCI 200 plus previously held time how much? 500. Total amount 900. Total amount of A will be 900. Total amount of A and 900. That means it includes purchase consideration plus NCI. But this purchase consideration 2 times we are paying. So one at the time of acquisition 200, one previously you paid 500. So you have to take an aggregate. You have to add these things, 200 plus 200 plus 200. Sorry, 500 plus 200 plus 200. That is what the meaning. If any business combination achieved in stages. Now a business combination achieved in stages, I put separate model. Okay, we will do some problems on business combination which is achieved in stages. Okay, so we can expect such kind of questions also in the examination. So I added one additional model for that. So there we can discuss it in detail. This is only for understanding. Okay, so generally you follow this one. Alternative method we will follow for all the problems. Okay, but in case if you want to go with A over B or B over A, what should be aggregate? Purchase consideration plus non-controlling interest. If any business combination achieved in stages, then previous equity interest also how much you paid, that also we can take into consideration. And so that we are comparing with what? With net identifiable assets. Okay, if aggregation amount is more than net identifiable assets, we will get goodwill. If aggregation amount is less than net identifiable asset, gain on bargain purchase. So entry later on we can see. Now you can bargain purchase. So generally bargain purchase means very rare cases it will happen, but in the examination point of view we will get every cases. Gain on bargain purchase, generally who will pay, Nana? For example, gain on bargain purchase means who will sell 500 lakhs worth of business for 400 lakhs. So generally, okay, either they should be under compulsion. Okay, either they should be under compulsion, and at most, okay, whatever the reason it might be. In extremely rare circumstances, the acquirer will make a bargain purchase in the business combination in the amount when here B, Nana, B exceeds the aggregate amount which is specified in A. If B exceeds the aggregate amount specified in A. So aggregation is A, no? Yes. So when the amount of B exceeds A, then we will get gain on bargain purchase. A bargain purchase might happen, for example, in the business combination, that is a forced sale in which the seller is acting under compulsion. So based on compulsion, he will sell, he might sell. Okay. So suddenly he required some cash, or suddenly if any amount is required, he can sell for lower than what it worth. Okay. So that is the thing, gain on bargain purchase. Generally in the real scenarios, very rarely it will come. But exam point of view, we have lot of problems relating to gain on bargain purchase. Okay. So now open your notes. So next, Nana, calculation of goodwill or gain on bargain purchase. Calculation of goodwill or gain on bargain purchase. So put particulars. Amount. Calculation of goodwill or gain on bargain purchase. First one A. And a fair value of this is a format, Nana. Fair value of net identifiable assets. Fair value of net identifiable assets of acquiree on the date of acquisition. Fair value of net identifiable assets of acquiree on the date of acquisition. We'll take the amount. Fair value of net identifiable assets of acquire. Net identifiable assets means identifiable assets minus identifiable liabilities, less non-controlling interest. Non-controlling interest in same in net identifiable assets. Non-controlling interest in net identifiable assets on the date of acquisition. Date of acquisition, put DOA. Okay. So total net identifiable assets fair value how much? From that, what we are removing, Nana? Non-controlling interest. Non-controlling interest means, so the persons who are having the other shareholders interest in the net assets, we are removing. So whatever the amount we are getting, whose share it is? Parent share This is parent share or acquirer share, anything you can write. Acquirer share in the net identifiable assets, NIFA. Acquirer's share in the net identifiable assets on date of acquisition. Acquirer's share in the net identifiable assets on the date of acquisition. Who is paying purchase consideration? Acquirer. So less purchase consideration. Next. E, no. If purchase consideration is more than acquirer share, then goodwill. So here, just for, this is only for understanding. Purchase consideration is greater than acquirer share. Then we will get goodwill. If purchase consideration is less than acquirer share, then it will be gain on bargain purchase. Okay. So which is nothing but D is greater than C, goodwill. If D is less than C, gain on bargain purchase. Okay, so before going to CRD problems, one example question we will do first. Now we got the format. First of all, Nana, fair value of net identifiable assets of which company? Acquiring company on which date? On the date of acquisition, less non-controlling interest. Less non-controlling interest in the net identifiable assets of date of acquisition. So then the balance amount, whatever you are getting, that balance is whose share? Parent share or acquirer's share. Acquirer's share in the net assets of acquiring company on the date of acquisition. And for that we have to compare with purchase consideration. If purchase consideration is more than the acquirer share, that means extra he is paying for goodwill. If purchase consideration is less than the acquirer share, so then it will be a gain on bargain purchase. Write down one example. Now X Limited, Y Limited. So X Limited acquires 80% of stakes in Y Limited. X Limited acquires 80% of stakes in Y Limited. On date of acquisition, purchase consideration is 9 lakhs. On the date of acquisition, purchase consideration is 9 lakhs. On date of acquisition, fair value of net assets. Here net assets means net identifiable assets only. Fair value of net assets is 7 lakhs. Fair value of net assets is 7 lakhs. So calculate goodwill or gain on bargain purchase. No, no. Calculation of goodwill or gain on bargain purchase. So our format we're having particulars. Amount in rupees. See how we have to make first one. 100% fair value of net identifiable assets of who is acquiring Y Limited on date of acquisition. 100% fair value of net identifiable assets of Y Limited on the date of acquisition. So Y Limited fair value of net assets how much, Nana? 7 lakhs. B, non-controlling interest. We have to deduct less. You can write less non-controlling interest. Nana, for time being, follow PSNA basis only. Proportionate share in the net assets. What is the value of net assets? 7 lakhs. What is NCI share? 20%. Because 80% is the parent share, means 20% is the NCI share. How much, Nana? 1,40,000. How much? 5,60,000. Whose share it is? Acquirer. So say share of X Limited. This is share of X Limited in the net identifiable assets of Y Limited on date of acquisition. 5,60,000. 5,60,000 worth the business requirement, whatever the acquirer share. How much he is paying for that? Less purchase consideration. Nine lakhs. Then don't write negative amounts or something. Okay, here we need to compare. So less purchase consideration means now purchase consideration more than the acquirer share. For 5,60,000 valued business, he is purchasing and paying 9 lakhs. How much extra he is paying? 3 lakhs. 3,40,000 extra he is paying. That will be the goodwill. Goodwill. So this goodwill is arises from business combination. This goodwill is arised from business combination. Okay. So if goodwill is arised from business combination, how to do accounting for this goodwill? We're having in Ind AS 38 intangible assets. And when we are discussing about intangible assets and impairment of assets, how to do the impairment treatment for this goodwill, we will discuss that both in Ind AS 36 and Ind AS 38. Okay. So here just goodwill finding out. So if purchase consideration is less than the share of acquirer, then gain on bargain purchase. Then gain on bargain purchase. So now completed, Nana. So check one journal entry also here we're having. So how to make the entries for this? First of all, net identifiable assets or identifiable net assets, how much? So first of all, net identifiable assets account debtor to NCI. Okay, first we have to make net identifiable assets to NCI. Next, to what you are paying the consideration. If you are paying consideration in the form of cash, so to cash. Or if consideration you are paying in the form of equity shares, equity share capital. Debentures means debentures, whatever it might be. Here they have taken cash. So this is what? Purchase consideration paid. Okay. So we are making NCI also. NCI we are crediting here. Okay. I told you NCI we will show like a separate line item, NCI will show under equity. It's a liability. So having credit balance. Okay. So here identifiable assets. How much net identifiable assets in this question? 7 lakhs. To purchase consideration, how much we are paying? 9 lakhs. Huh? So check it out. 9 lakhs we are paying. So non-controlling interest how much? 1,40,000. So 9 lakhs and 1,40,000. So the balancing figures, debit side means goodwill, credit side means gain on bargain purchase. So credit side is highest amount. How much? 1040 minus 7 lakhs. So 3 lakhs, 3,40,000 goodwill we are getting for this case. 3,40,000 goodwill. Clear? So generally we are framing the entries like that. Net identifiable assets account debtor to NCI account. First you have to write NCI. Don't forget to write NCI. So net identifiable assets account debtor to NCI. So net identifiable 7 lakhs and NCI 1,40,000. Next, to purchase consideration you paid through cash means how much, Nana? 9 lakhs. Now the difference, debit side means goodwill, credit side means gain on bargain purchase. So debit side how much we got? 3,40,000. So that will be goodwill. So entry we have to form like this. Okay, so frame the entry for this, Nana. Journal entry. So net identifiable assets account debtor. How much? 7 lakhs. To non-controlling interest account 1,40,000. To consideration, how we are paying we don't know means you can write consideration also, not an issue. Write to consideration or purchase consideration. How much? 9 lakhs. So balancing figure whatever we got, 3,40,000. So this will be the balancing figure. Goodwill account debtor 3,40,000. This will be the balancing figure. Okay, Nana. Net identifiable assets directly given in the question means we did like that. Sometimes they will give you identifiable assets, identifiable liabilities. So identifiable assets minus identifiable liabilities we will get. So in the time of entry, assets you will debit, liabilities you have to credit. Instead of writing net identifiable assets, simply identifiable assets account debtor to identifiable liabilities to non-controlling interest to consideration. The difference will be goodwill or gain on bargain purchase. Separately, if it is given, separately you have to show, because we are taking the assets having debit balance, we have to debit it. Identifiable liabilities when we are having, we have to credit it. But in the question directly net identifiable assets given, we have taken the net amount because we don't know how the separation of assets and liabilities. If separation is given, separately we will do, or otherwise net value we can take into consideration. Clear? Once you go through all the elements what we have discussed now, and we can start problems from tomorrow, CRD problems. First model discussed about goodwill or gain on bargain purchase. Once you go through it, Nana. So textbook also, textbook elements also. Nana, if you are not understand the aggregation amount, just you leave it, not an issue. Okay. So here we have two methods. Alternate method. This method is easy for you to compute goodwill or gain on bargain purchase. Or same question you tell me in the first pattern. Aggregation means purchase consideration plus non-controlling interest. Purchase consideration plus non-controlling interest. In this question, business combination achieved in stages or at the beginning? It's at the beginning. So achieved in stages is not there. For the first time when we are investing into the company, 80% we invested. So immediately business combination is arrived. It is not achieved in stages. So third point, leave it. So what you have to aggregate two aspects. Purchase consideration, how much, Nana? 9 lakhs. Non-controlling, total amount. So 9 lakhs plus 1,40,000. 10 lakhs 40,000. This will be considered as A. A is nothing but aggregation of purchase consideration, and non-controlling interest. Non-controlling interest. So now what is B? Net identifiable assets. How much, Nana? 7 lakhs. Now A is excess than B. So how much excess of A than B? 3 lakhs 40,000. That will be the goodwill. So excess of A over B is goodwill. If excess of B over A is nothing but gain on bargain purchase. Just for time understanding, that's it. Okay. So you have to follow the format like this. This is example question. The same format we are doing for major problems also. Okay. So once you go through it, tomorrow we will start CRD problems from business combination.